Welcome to The Explainer. Have you ever looked at the ultra-wealthy and thought, man, they are playing a completely different game? Well, you're not wrong. According to the fascinating source material we're looking at today, there's a whole system operating behind the scenes called the debt matrix. Let's dive right in together and actually reverse engineer the exact mathematical and tax frameworks the financial elite use to build and sustain their fortunes. Get ready because these insights are absolutely going to shift how you look at money. Here's our roadmap for today. We're going to hit the great credit illusion, the anatomy of money, the billionaire blueprint, the debt cycle playbook, and finally, your financial fortress. By the end of this, you'll have a clear understanding of a practical escape route from the traditional financial matrix. All right, let's jump straight into section 1, the great credit illusion. So I want to pose this question directly to you. Is debt a financial prison? Just take a second to think about what you were taught growing up. For most of society, debt is framed as this awful lifetime sentence, right? Monthly installments, crazy high interest rates, and just constant underlying anxiety. It's the cage that keeps you trading your time for money. But what if that's only half the story? Notice the stark, almost jarring contrast here. While the 99% view debt as a total burden, a trap of consumerism, the global financial elite view it entirely differently. To them, it imparts power. They see liabilities as a legal tax shelter, an instrument for infinite scale, and basically the ultimate wealth weapon. For them, it's not a cage at all, it's a tool. To really grasp how they wield that tool, we need to look at section 2, the anatomy of money. We have to unpack this foundational mechanic because it's absolutely crucial. In the modern economy, money isn't backed by gold sitting in some giant vault. Every new dollar or euro is actually created as a debt obligation. When central banks lower interest rates, commercial banks issue more loans, and boom, new currency is effectively created out of thin air in the digital ecosystem. Because new money enters the market as debt, the purchasing power of your saved cash gets mathematically diluted over time. Basically, if you only save cash, you're fighting a losing battle against mathematical will. And this brings us to what the sources call the leverage threshold. This is the crucial metric that separates financial ruin from financial freedom. On one hand, we have bad debt. This is borrowing money at high interest rates to buy depreciating liabilities, things like cars or luxury goods that lose value the second you buy them. It traps your future labor to pay for past consumption. But then we have good debt. This is asset-backed leverage used to acquire appreciating high-yield assets at super low interest rates. In this scenario, the asset literally pays off the debt and you keep all the capital gains. So how do the ultra-wealthy actually use this at the highest level? Welcome to section 3, the billionaire blueprint. 40%. I really want that number to sink in for a second. That is the massive capital gains tax penalty an ultra-wealthy individual would trigger if they just sold their fortunes to cash out. Imagine spending decades building a billion-dollar empire. If you sell it the traditional way, you're handing over nearly half of it in taxes. So they just don't sell. Instead, they aim for this number, 0%. It's genuinely mind-blowing when you realize the asymmetry of the tax code here. 0% is the exact income tax paid on loan proceeds. Because a loan isn't legally classified as income, the elite use it to generate massive liquidity without giving up a single cent to income tax. Which leads us to the precise 3-step institutional framework used by billionaires, widely known as buy, borrow, die. Step 1 is buy. They funnel income into high-quality, scarce assets like blue-chip equities or commercial real estate, and they just hold on to them forever. Step 2 is borrow. They take out a low-interest loan against the value of those assets to get tax-free cash. And step 3 is die, passing those assets into a trust which totally resets the tax board. Let's break down exactly how those last 2 steps actually work. Let's look at the borrow phase. They use something called a securities-backed line of credit, or an SBLOC. Imagine having a $100 million asset portfolio. Instead of selling it for cash, you pledge it as collateral to an investment bank. The bank then hands you a $30 million line of credit at a minimal interest rate, maybe 3 or 4%. You now have $30 million in liquid cash to spend or reinvest, completely tax-free, all while your original portfolio continues to grow in the background. And here is the grand finale, the die phase, which relies on a mechanism called the step-up in basis. When the asset owner passes away, the assets in their trust are revalued at the current market price for their heirs. This legal loophole completely wipes out decades of built-up capital gains tax obligations. Just poof, gone. A tiny fraction of those newly untaxed assets can then be used to pay off the original loan, and the whole cycle seamlessly repeats for the next generation. So, how do they time this massive machine? Let's look at Section 4, the Debt Cycle Playbook. The source text points out that wealth transfers violently during specific macroeconomic cycles. During the expansion phase, credit is super easy to get. The elite borrow heavily to buy scalable business assets, while the masses take on everyday consumer loans. At the peak, when inflation rises and rates hike, the elite freeze their expansion and just accumulate cash. The masses, on the other hand, usually succumb to FOMO, buying everything at maximum prices. Finally, during the liquidity crunch, the elite deploy all that hoarded cash to buy distressed assets for pennies, while everyone else is tragically forced into panic selling. This dynamic is known as the liquidity trap. During a market crash, cash isn't a long-term investment. It's a temporary tool for absolute dominance. When everyday folks are forced to liquidate hard assets at steep discounts just to survive, those with pre-saved liquidity swoop right in. They acquire generational assets at 50% off, locking in massive asymmetric gains for the next expansion phase. Let's synthesize this into something usable. Let's explore Section 5, your financial fortress. To stop being a participant in the debt matrix and actually start mastering it, the text outlines a multi-phase strategy. And yeah, the names are a bit of a mouthful. Phase 1 is the arbitrage arbitrary, Phase 2 is asymmetric asset aggregation, and Phase 3 is the infinite reinvestment loop, but the concepts themselves are actually quite simple. Let's walk through your action plan. Phase 1 is all about building a zero liability foundation. Look, before you can even think about utilizing leverage, you must eliminate all friction. You need to aggressively wipe out every single piece of bad consumer debt. From there, your goal is to establish automated income streams, like online or media income, that cover 300% of your baseline lifestyle cost, totally debt-free. This is your absolute mandatory baseline before leverage is even an option. Once you've got that rock-solid foundation, you move to Phase 2, asymmetric asset aggregation. Here, you shift your production towards scalable digital assets, intellectual property, or enterprise equity that require absolutely zero debt to start. You then take the high-margin cash flow generated from those digital assets and use it to buy radically scarce physical assets, like prime real estate. Why? Because these are the exact hard assets that traditional banks are eager to lend against. You're setting up the board for the big leagues. And that triggers Phase 3, the infinite reinvestment loop. Now that you own appreciating hard assets, you initiate that exact institutional wealth loop model we discussed earlier. You use the equity in your assets to secure low-interest credit. But here is the secret, the golden rule. You never spend this borrowed capital on your lifestyle, ever. You inject it directly into high-frequency reinvestment, scaling your business, expanding distribution, or acquiring competitors. As long as your business growth outpaces the interest rate of the loan, you've created an exponential, limitless wealth loop. Which brings us to this incredibly powerful takeaway from our source material that just hits the nail on the head. Stop viewing debt as a way to fund a lifestyle you haven't earned yet. The financial system is literally designed to keep you on a treadmill of consumerism. To break out of that cycle, you have to completely rewire your brain to view debt the way the 1% does, as a highly calculated, sterile tool used exclusively to multiply asset ownership, not to buy depreciating liabilities. I want to leave you with a final, provocative thought to chew on today. Take a real, honest look at your own finances right now. Are you currently using debt as a cage, trapping your future labor, or are you preparing to use it as a lever to multiply your wealth? Thank you so much for joining me for this explainer. I really hope this deep dive challenged your perspective and empowered you with some real, structured knowledge straight from the source text. I would absolutely love to hear your reflections on this. Stay analytical, and I'll see you next time as we dive into another fascinating explainer of the world's most complex source materials.